So every morning I check out all these different graphs and just wanted to share this to you guys. So one of the data sets from Doxo posted on Wall Street Journal has to do with a likelihood of a person delaying what specific type of bill. Obviously, rent for landlords is going to be a big issue. Mortgage being a lot lower on the list, as you can see. And you have a lot of different other bills that are being pushed to the bottom or delayed if possible. Unfortunately, one of the big things that we're watching very closely is hourly employees and their income reduction since the virus has hit, and it's been steadily decreasing. Over time, it's interesting to see how this is not with inflation adjusted numbers, but what the actual year-over-year growth rate of wages has been. These are all positive. That being said, it has been positive in a declining basis over the last 30, almost 40 years. Unemployment relative to Canada is a lot higher, as many of us have already forecasted almost 25% unemployment, even though a lot of the numbers that you're seeing aren't reflecting that total percentage because of people who just have left the marketplace. One good thing to note is that occupancy rates slowly recovering is a sign that there's a lot of other factors that might be improving. And this is steadily over time, as opposed to just, say, the Memorial Day weekend. What I'm looking at here is potentially business activity that might be picking up across the U.S. marketplace beyond just people who want to go on vacation. So onshore, offshore, manufacturing process is a big factor that's been talked about for the past several decades, where a lot of companies are starting to reshore a lot of their manufacturing operations. That is a good, bad sign. Good sign, obviously, as people are trying to shift supply chains, logistics, infrastructure back to the U.S. marketplace from a domestic consumption and production standpoint. On the flip side, that could also spell longer-term inflation of prices, as you're not going to get a discount from foreign market export arbitrage. Money supply is something that I personally watch. Most of the marketplace looks at M1, M2 money supply. I think M3 is a little bit more difficult to find. I haven't seen the Fed publishing that. That may be incorrect, but I looked at this analysis, and it's unfortunately interesting to see that the supply of cash has obviously skyrocketed. The only thing I think that's holding our inflation rates down is, yes, there is sector-specific deflation, but the U.S. dollar is pretty strong and holding steady relative to the other currencies globally, and that's creating this effect that's not creating a major spike in inflation so far. This is the Chinese renminbi versus the dollar conversion rate. It is suffering dramatically at almost from 6 to 7.2 renminbi per US dollar. And, that's one of the major things to be watching, even though the Chinese economy has recovered, relatively speaking, compared to the global markets related to the virus. This is an indicator that there is definitely a weakening, and there's some other data that I had looked at. So this is one of the other major factors. So if you look at over the past 20 years, this fiscal balance as a percentage of GDP, is really, really interesting in that it is a pretty big drag on as a percentage of GDP, and that's not a really good sign long term. So to give you more context, this is how to actually look. So the official fiscal deficit at 3.5% relative to a lot of these adjustments that the marketplace is looking at being closer to 9-10% of GDP of China. So This has to do with Hong Kong, which is having some major issues now with change of policy between China and Hong Kong. What I'm looking for here is not only on the market index, but on the property index. Are there a lot of the wealthier investors and landowners leaving Hong Kong to other marketplaces beyond just the virus? There was, as you can see, a recovery to some degree and then a major sharp pullback. So I don't know what's going to happen, but if this index goes a lot lower than the low that was hit in the March timeframe, this could spell long-term ramifications to the downside. So commodities, definitely something that has been in the negative for a pretty long time, over a decade or so. And there's two sides to that equation. Obviously, consumption overall on a lot of these commodities have reduced on a global basis. That being said, we might be in a situation where there's a turnaround in commodities. Obviously, oil has significantly weighed on the commodity index basket as a whole. That being said, we think that at some point in time there might be a recovery. I'm not saying that I'm going to follow these dotted lines going over the next couple years, but that being said, I don't think that there's no opportunity on a go forward basis on the commodity side. As many of you know, I have a pretty moderate size allocation, around 7.5% of my wealth preservation bucket on commodity baskets and specific indexes and commodity allocation. So I'm not necessarily bullish, but it's a part of the allocation. And I think that hopefully in the next year or so, there should be some neutralization from the pullback. Gold, still on a tear as far as consumption is concerned. This is GLD, the ETF, and there's just been constant inflow this year on gold. It's slowed down a little bit. That being said, you're talking about some major highs, historic highs against the dollar, relatively speaking. So dollar index, something I watch very carefully. As I talked to you before, it is at a support level that's had some level of sustainability. I think hopefully that can continue even though the money supply has skyrocketed, mainly because as the economy, the stock market has recovered, not necessarily the economy, relative to the other countries of the world, we're doing pretty good from that standpoint. We had a lot more room for error. And if this holds up, that'll hold down a lot of that inflational impact from an increase in money supply. So we're going to be watching the dollar closely. So this is an annualized return expectation by the different equity baskets. I can't remember which firm it was that actually posted this, but it's looking where there's major declines has the longer term opportunity over a multi-month time frame. That being said, if you're going to obviously buy U.S. government bonds and you're looking at the yield side, doesn't make a lot of sense. That being said, I think on the bond fund side, where you're making money as the price goes up and the yield goes down, there's definitely opportunity, as the Fed will probably most likely continue to buy, including that on a global basis as well. That being said, with European and emerging market equities having been so depressed, there is a potential pullback and a rally that may come up. That being said, U.S. equities have already rallied significantly. Hopefully, we're not looking at a bear rally, which is one of the big concerns that is across the board. One obvious component that most of you are not probably surprised is that global trade has dramatically declined. Obviously, countries like that are in Europe are having some massive pullbacks. Commodity specific, or what I call single commodity or double commodity based countries, similar to like Russia, oil export economies are having major struggles as their commodity consumption has globally declined. This is an interesting graph, specifically for the U.S. marketplace. As far as debt is held by age bracket, there's been an overall increase from, if you look at 2008, whenever we were right at the crash, a little over 12 trillion.